Hello, I'm Tim Beggins, president of Elk Trading Company. In today's article, the U.S. Iran peace deal, a potential game changer for energy investors. In today's article, we've got a picture of our two negotiators here from both the U.S. and Iran. This is a source from the Mir news agencies out of Iran. A renewed peace agreement between the U.S. and Iran, potentially reviving or replacing the JCPOA, could reshape global crude oil dynamics and create ripple effects across the energy investment landscape. If sanctions are lifted, Iran could rapidly scale exports from 1.5 million to 2.5 million barrels per day, echoing the post 2015 surge. This additional supply, entering a market already wrestling with weak demand, China's slowdown, could drive crude oil prices, Brent crude oil prices, down by $5 to $10 a barrel, potentially settling in the $55 to $60 range. For investors, the implications are significant. Bearish pressure on oil prices could impact margins for high cost producers, especially U.S. shale. Reduced geopolitical risk premiums, historically worth $5 to $10 per barrel, may compress volatility-based trading strategies. And OPEC Plus responses will be crucial. With over 5 million barrels of oil spare capacity, coordinated cuts could buffer price movements on the downside, but timing and cohesion will remain uncertain. And lower Permian drilling activity, driven by weaker crude oil economics, could reduce associated natural gas output. This may tighten supply to U.S. Gulf Coast LNG terminals, potentially supporting domestic gas prices even in a low oil environment. The timeline to watch. The third quarter to the fourth quarter of this year, negotiations progress, sanction relief could begin. Iran could add approximately 500,000 barrels per day. In 2026, exports could reach that 2.5 million barrel per day output, stabilizing prices unless global demand rebounds. And 2027 and beyond, full integration could boost infrastructure flows via the Strait of Hormuz, though sustained low prices may limit upstream capex globally. There are some risks to monitor. One, political volatility, including U.S. elections and congressional resistance. Number two, regional tensions involving Israel or the Gulf states. Number three, global demand weakness and economic uncertainty. And number four, supply disruptions or offsets from other producers like Libya or Venezuela. The bottom line for investors: Iran's re entry could depress prices and reallocate trade flows, but also open up long term opportunities in logistics, storage, and downstream refining. Watch for secondary impacts on natural gas markets, particularly around LNG feedstock availability from the Permian. Flexibility and geopolitical awareness will be key to positioning portfolios ahead of these shifts. Let us know your thoughts in the comment section below. Please hit that like and subscribe button. Thanks for listening. We'll see you soon.